Hi everyone, and welcome to our webinar. Today we'll be interviewing our 2017 Investor of the Year and reviewing case studies of the two investments that helped earn him that award. I'm Keith Blazik, your host from Equity Trust, and I'm happy you're joining us. So let's quickly run through what we'll cover today. We're going to start with a quick overview of self-directed retirement accounts, and I'll highlight the Coverdell Education Savings Account in particular because Brian used that account type in both of the investments that we're going to be showcasing a little bit today. Then we'll have a chance to talk with Brian, learn more about his investments and his experience as an Equity Trust client before moving on into some other information. Also, I want to mention that if you stick around to the end of this webinar, I will share how you can get a free copy of our book, The Self-Directed IRAs, Building Retirement Wealth Through Alternative Investing. It's a pretty comprehensive resource for all topics related to self-directed IRA investing, details each of the different accounts that are available, has over 30 different case studies of Equity Trust client investments, and really just as 200 plus pages of information and education all about this topic. So if you're looking to learn more, stick around to the end and I'll make sure I get you a free copy of that book. So now that we know what we will be covering today, let's touch on what we won't be doing. Equity Trust Company is a passive custodian and does not provide tax, legal, or investment advice. This webinar is for educational purposes only and should not be construed as tax, legal, or investment advice. The case studies we review today are also for educational purposes only. Past performance is not indicative of future results. All investing involves risk, including the possible loss of principal. And finally, we recommend that you always consult with a tax attorney, a financial professional advisor, and perform your own due diligence before making any investment or financial decisions. So you learned in the disclaimer that we're a passive custodian and we won't be providing investments or investment advice. So what do we do? Well, who is Equity Trust? Well, we are an industry-leading custodian of self-directed retirement accounts. We're headquartered right outside of Cleveland, Ohio. You can see our corporate headquarters on your screen. We specialize in notes, real estate, private equity, precious metals, and a whole host of other alternative assets. But we also support traditional investments like stocks, bonds, and mutual funds as well. So really at Equity Trust, we try to provide our clients the freedom to be able to invest how they see fit. We provide 7 different tax advantage accounts for individuals and business owners that can be used to save and invest for retirement, for healthcare savings, or education savings. So for individuals, we offer traditional and Roth IRAs, the health savings accounts, and the Coverdell Education Savings Account. Coverdell Education Savings Accounts, or CESAs for short, are tax advantage accounts designed to save and invest for qualified education expenses. CESAs are opened in the name of a beneficiary that has to be under the age of 18, can have a CESA in their name. And because they're the only account that doesn't require earned income to contribute. And it's also possible for anybody to contribute to that CESA on the behalf of that beneficiary. So you can even have a combination of different people to do so. So the child can contribute money from their allowance or their birthdays, which is a great way to start teaching them good money habits and saving money and that type of thing, or a combination of parents, grandparents, friends, relatives, anyone can contribute to that child CESA if they wish. The only caveat is that the maximum amount that can be contributed to a CESA per year is $2,000, and up until the age they turn 18. So that means no matter who contributed, the max that can be put in is $2,000. So if mom puts in $1,000 and grandpa puts in $1,000, nobody else can put any other money into the CESA for that particular year. The contributions don't provide a tax deduction, and after the beneficiary reaches age 18, you can no longer contribute to the account, but it's possible to keep investing with that account up until the age of 30. Any investments or investment earnings while inside the Coverdell Education Savings Account are able to grow and compound without being taxed while they're inside the account, assuming that all IRS rules are followed. And once the account, the benefit to the CESA, though, is that once money is removed from the account, it's tax-free as long as the distribution is for qualified education expenses, like a tuition, whether it's K through 12 private school or college tuition, and other qualified education expenses. But the CESAs, then those distributions can be used tax-free from the account as long as they're qualified education expenses. So in just a bit, we'll share how Brian partnered 3 of his children's CESAs together on 2 different investments to help build tax-advantaged wealth to help pay for his children's education as they get older. So back to our overview of the 7 different accounts available at Equity Trust. We touched on the ones for the individuals, and for business owners, we also offer the SEP IRA, the Simple IRA, and the Solo 401k. The main difference with the small business plans is that they have higher contribution limits and potentially larger tax deductions for those who qualify. But we won't get into those accounts too much, but if you have questions about that, feel free to send us an email or follow up with us, and we'll be happy to share those with a little bit more detail. But at this point, a common question that we get is, how are our accounts different from an IRA or an HSA or a SEP IRA that is held somewhere else? And in reality, the account itself, regardless of which of the 7 we're referring to, is the same everywhere. The rules, the laws, the contribution limits, the eligibility requirements, etc., for a Roth IRA or a SEP IRA or an HSA at Equity Trust are the same as if you held one of those accounts elsewhere. The main difference, however, is that the accounts at Equity Trust have the freedom and the flexibility to invest in both alternative assets and traditional assets. The term self-directed is simply an industry term to differentiate the increased investment flexibility and our role as a passive custodian. So sometimes someone will ask me, can I buy and sell real estate with my Roth IRA or my kid's CESA like I can with my traditional IRA? Can I self-direct those accounts too? And the answer is yes. As we move into Brian's case studies, keep in mind that it's possible to invest in both traditional and alternative assets, like real estate, for example, with any of the 7 accounts listed here. Ultimately, it's your retirement, or it's your health savings account, or it's your child's education savings account. At Equity Trust, those are your goals. At Equity Trust, you have the freedom to get there your way by investing in what you know best and directing your funds the way you see fit. Our role as a passive custodian is not we won't give you any advice or push you in any particular direction. Our role as a passive custodian is to provide the education and the service to support your wealth building as directed by you so that you can reach your goals. So that's really when it comes down to when we distill down a self-directed IRA at Equity Trust. It's where we custody the account and then hand the keys to you in all direction and decisions and all of the things that happen with it. So we don't have time to get into the specifics of each account or the different tax advantages and the eligibility requirements for each, but feel free to give us a call or schedule a consultation to talk to a senior account executive if you have questions. You can also send us an email to webinars@trustetc.com. As I give you a second to write that down, I also want to mention it's possible to have more than one of the account types I listed and went through a little bit ago, assuming that you're eligible. As you'll see when we talk to Brian, he was able to partner multiple accounts in his family on a single investment to help grow them all together. So even if you have an IRA already or you're currently a client of Equity Trust, give us a call or reach out to us if you're interested in exploring additional account options. So at this point, I'd like to welcome Brian, our 2017 Self-Directed Investor of the Year, to the call. Brian lives in Tennessee and has been a client for right around 5 years now. In fact, Brian and his wife each have a Roth IRA and a SEP IRA with us, and each of his 4 young children have a CESA as well, bringing it to a total of about 8 different accounts for Brian and his family. Brian, welcome, and thank you for taking the time and joining us today.
All right, thanks. I'm looking forward to the discussion.
Great. So Brian, why don't you start by telling us a little bit about, yourself and your background, and then how you kind of first found out about self-directed IRAs and what made you, decide that that was something that you wanted to do.
Actually, an accountant mentioned it to me. It suggested that I started, trying to do some sort of retirement account, especially for the tax benefits and traditional IRAs where you can write them off and things. And I have a background in real estate. I'm also a licensed optometrist. I went to school for that, and mostly to earn enough money so that I could invest in real estate. I guess, and right now I'm a licensed real estate broker. So I tend to, most of what I do is look for things to buy and sell.
Okay. So were you investing then in real estate already before you found out that you could use your retirement account to also invest in real estate? Is that correct?
It is, yeah. And I guess one of the big things that happened is I bought a property and I owner financed it for someone. I bought it, got a really good deal on it, and I owner financed it for them. And when I did, the gain that I had to realize on that, I paid, well over $10,000 in taxes, and I just wasn't really anticipating how much money I was going to have to pay in taxes. And I think that's probably what got the conversation started about these short-term deals, trying to find another way of doing them rather than paying out such a large portion of it.
Yeah, certainly. That the tax benefits is one of the main reasons that people, look at self-directed IRAs. How did you first learn about the CESA as an option at Equity Trust as well? Was that after you had already been a client with your own Roth IRA for a little bit, and then you found out about these accounts, or when did you kind of make the connection that you could also be investing your kids' education savings accounts with your real estate and transactions that you were doing with your own IRA?
Well, that's exactly it. I'd done an investment or two with my own, and I think I asked the account specialist, I asked him, I was like, are there any other types of accounts that I can get involved in? Because I saw the potential of, what could be done. And then he explained the different things you guys offer, one of which was the CESA, and then that, went from there.
Mm-hmm. So for your children's CESA accounts, obviously you came with that, you got to that point of, all right, the $2,000 maximum limit, what can I do with this? So how was that? Walk me through a little bit of that thought process of how you got them to a point or where you felt, okay, I can now come do something with these to invest.
Oh, well, knowing that you can partner them with other accounts, I mean, you can actually do something with the $2,000 that you can put in once a year. And if, so no matter, it just is a natural thing to pair with having any type of IRA or traditional IRA or Roth IRA to go ahead. And if you've got children that are, anything less than college age, it makes sense to put the money in there so that it can be part of those investments. But since those account contributions are so low each year, that's where you want to save that for the very best of investments that you can find that require the least amount of capital or just really have the greatest return. I mean, it doesn't matter if it's a $100,000 or $200,000 deal. If you're making 50% on it, stick your kids' money in there with it.
Yep, absolutely. And you touched on a couple of things that I'm going to kind of call out for a second to help paint the picture for our listeners, because it's common that investors will start and say, if I don't have a lot of money into an account, whether it's a CESA or a newly opened IRA, what am I supposed to do? How am I able to invest with a smaller account balance? And there's three. You touched on kind of all three of the methods that you eventually ended up using with your case studies, which we'll touch on in a second. But the first is, if you're able to make regular contributions, obviously putting more money into the accounts each year is a direct way to increase the account balance. And even if you can't max out the contributions, any amount can help. So at this point, a lot of investors will stop me and they'll say, well, Keith, that's great and all, but what can I do with only $2,000 in a CESA each year, or only $5,500 in an IRA each year? And my counter to that is, well, more than you can do with $0. And it's, every little bit helps and starts moving you in the direction that you want. And plus, like you mentioned, Brian, if you can, even if it's just the $2,000 or $500 or whatever, if you can do that every year after just a few years of contributions, then that account balance might be to a point where then maybe you are able to start investing or doing something with it. Is that's kind of how was your experience with the CESA? I know in the past you had talked about one of the accounts you were able to at least get 2 years of contributions in there, which was might have taken a little bit of time, but at least those regular contributions is one way you had funds available to kind of get started.
That's exactly right.
Mm-hmm. So, the most important thing is to get an account open and started. And, if 3 years ago, someone listening didn't open a self-directed IRA because they didn't think, the 5,500 annual contribution limit would be enough to invest. But if they took action and maxed out that IRA over the last 3 years, they'd have, $16,500 in the IRA just from contribution alone. And then secondly, as Brian's going to share in a second when we get into his case studies, another method is by finding smaller dollar investment opportunities. Over the years, we've seen plenty of equity trust clients find investments for less than $10,000. And while they might not be as common, it's certainly possible, and Brian's case study is a reflection of that. And then finally, as we'll see next, it's also possible to partner multiple accounts together on a single transaction. So even if one account doesn't have enough to make the investment by itself, it may be possible to partner with other accounts or other investors to get that smaller account balance invested. So Brian's investments and what he's done does a much better job demonstrating this than I can. So let's see how he combined those 3 methods to grow his kids' CESA accounts. So Brian, why don't you tell us a little bit about the first investment that kind of kick-started your 3 kids' CESAs? And it all started with when you came across a vacant lot in Nashville, correct?
Yeah, that's right, yeah. Yeah, so, I was driving around. I often drive for properties, look for sale by owners and things like that, just looking for leads, really. And this was at a dead-end street that, I really didn't want to drive down. I went down the street, and I turned around right at the end of it, no cul-de-sac, and as I pulled up in there was a small for sale by owner sign. And, I texted the guy that owned it. I tried calling. The phone number didn't have a voicemail set up. So then I sent him a text, and he eventually texted me back like 2 or 3 days later and said that he wanted, $8,500 for the land. And it was right next to a double-wide mobile home, but right in front of it was a mobile home park. But down the street and around the corner, they were already building new houses that were selling for $300,000, $300,000 to $500,000 range. So the area was coming up fast. And then I think I tried to contact the owner of that mobile home park to see if he wanted to sell. And coincidentally, he had it listed with a commercial broker. I just didn't notice it online up for sale. So I knew he had that for sale. Even though there was no signage, he didn't want the tenants to be aware of that sale. Yeah, I wound up negotiating with the guy because he wanted $8,500. I made him an offer of $8,000, and he agreed to take that. So I just partnered it up with the 3 accounts. But knowing that the mobile home park was for sale, they were already developing down the street. Property was starting to turn in the area, so you could see the potential that someone would want to build something on it within the next year.
So you saw that there was the vacant lot, but it was really, you saw the potential going forward of, here was that smaller dollar opportunity that we were talking about that stood out to you because you were looking for ways to get your kids' CESA accounts invested, and this just happened to show up, and you saw some of the profit potential in it because of things that were going on in the area.
Exactly. Yeah.
Great. So then you went and then decided to take 3 of your children's CESAs to partner in to buy that raw land. How did that process go? And Was the one account have more funds than the other two?
Yeah, that's right. It did. I don't remember the months exactly, but I think that one account, you can, up until the tax filing deadline, you can put in the previous year's money. So I was able to put in like 2,000 for the previous year and 2,000 for the current year in that account. So, it had the 2 years of contributions all at once. And then the other two were probably, seeing that they were round numbers, I don't remember exactly, but those contributions were probably from that current year. Probably made all those contributions in January and, had the money just sitting there, perfectly waiting on this property.
Oh, great, great. So then after you didn't take very long then, once you had the property under contract, it was titled in the name of the 3 IRAs with their percent ownership. So then how long until the property then sold? This was a pretty quick turnaround, wasn't it?
Yeah, I think I was a little surprised by it. I expected it to sit on the market for a while. But thinking back on it, I think it was something like 90 days. I thought it would probably take up to a year before it actually turned. But, the good news is that it sold fast for me. But I've not told you guys this before, but I think I might have missed a little opportunity because the people that bought it rezoned it. They had the same idea, seeing that it was developing fast. They bought it, rezoned it for 2 houses, and now they're going to build 2 houses on it instead of 1. I don't know if they've built on it yet or not, but I would say the current value of it is probably 150. So it's went up from there.
Wow. So obviously the development and the things, the clues that you saw of the mobile home park being for sale, the other things that are going on in the area, it seems like you were pretty spot on with that, and the other investors saw the same thing. So that was obviously a worthwhile investment. And to take, share a little bit for our listeners, that $60,000 sale price, because the CESAs all had a percent ownership in the land, that 60% is then split according to the percent ownership arrangement. So if the one CESA, which had the 2 years of contributions, owned 50% of the initial purchase of $8,000, it received 50% of the sale price, which was roughly, right around $30,000. And then the remaining half was split between the other 2 CESAs, right around $15,000, give or take on that. And the cool thing and the great thing about this first investment was not only, Brian, you were able to get your children's CESA accounts to really increase in value, but also that those funds, that $60,000 that's split between the 3 accounts, is tax-free as long as those funds are used for qualified education expenses at a later date. So just for one investment within, just a month or so of doing so, not too bad of a turnaround.
No, it was really good. And, and if I would have taken that as an individual, just bought it myself, sold it myself, and made the $50,000, I would be writing the IRS a check for an additional probably 16 grand or so. Probably 35% on a short-term gain like that. So, that's, instead of giving that to the IRS, I'm able to give it to my children.
Yeah, and the great thing about that, which that's a great, I'm glad you mentioned that, Brian, because what in lieu of not just writing that check to the IRS, but those funds remain in the account tax advantage so that then they can be reinvested into a next opportunity, which we'll touch on a little bit later. But that's kind of the power of being able to compound these things in the tax advantage environment over, so that instead of, $10,000 or whatever the case may be, leaking out, being paid to the IRS, it's still there ready to be invested into the next opportunity. Is that kind of something that, obviously that was one of the main benefits for your investment on this first one, because you mentioned how it kind of got your kids' CESA accounts started and being able to kind of get more into the game.
Mm-hmm. Yeah, definitely. I mean, that's a major factor. Getting the balance up, like everybody's concerned about in the beginning. How do you get the balance up? And it's like, well, you start somewhere. But a person could get to $30,000, even with yeah, that's a really good investment, and it's really lucky, and you're not always going to find one where you're going to make $50,000 off of $8,000, but you can find something to make some money, and as long as you're making those regular contributions, you're going to get it to where you can buy, a $50,000 rental. I mean, those are still available within an hour of Nashville, and kick back and let the rental pay your kids' college tuition, or pay a chunk of it at least.
It's incredible, Brian. And really, it's that first investment, like you said, it might not be typical, but it's one that you happen to found. There's others that are out there, but it doesn't. The concept is really the great thing that we're kind of showcasing here. That the numbers for every investment will change, but the concept of being able to do this and the tax advantages of these things for the account, whether it's your retirement account or your kid's education's account, that's really the great point. You nailed it right on the head with what you're talking about. Just whatever it is, as long as you're active and invested, then you're moving in the right direction. So I want to jump in here for a quick second because that first investment stood out to me for a couple of reasons. As someone who graduated with student loan debt myself, what you're doing, Brian, for your children's future resonated with me personally. I saw an article in Forbes recently that there's now more than $1.3 trillion in student loan debt across the country. It's now surpassed credit card debt for the first time in history and is the second largest category of consumer debt behind only mortgage debt. Secondly, the cost of education has skyrocketed in the last few decades. I saw a study a couple years ago that the LIMRA Secure Retirement Institute had, that they found the average student loan debt in 1990 was approximately $10,000. But by 2015, it more than tripled, and the average student loan debt reached $33,000. And one other finding from that LIMRA study that really, I'll tie this together to that last investment because that's the connection I made in my head, but the study found that the average student graduating with $30,000 in student loan debt could mean up to $325,000 in lost retirement savings. The study found that those with student loan debt typically prioritize paying down their student loans principal and interest and are more likely to skip out on saving and investing for retirement. So in reality, student loan debt has the potential to serve as this double-edged sword where the loan's compound interest is working against you while also potentially missing out on the compound interest working for you in a retirement account or a Coverdell Education Savings Account, which brings me back to that last investment for Brian's children, CESAs, that your one child returned back, it was approximately $30,000 just from that first one. And that's connected to that $30,000 stat from the LIMRA study because, you're creating a way to potentially give your children not only a way to say, pay for their education and things of that nature, but also giving them a head start, potentially a $325,000 head start on their retirement savings by giving them methods and ways to reduce their chances of going into student debt.
Student loan debt is a huge problem that so many people are facing right now. I mean, I know a lot of people, they go to school, they get out, they're a doctor, or in my situation, I was an optometrist, a doctor of optometry. And back when I graduated, the average debt was something around $150,000. And I actually was talking to the financial aid guy when I was graduating, and he said that it was projected to go up like $25,000 a year every year after. And reading other forums recently, it seems like that average debt of an optometry school student is around $250,000. And that's a tremendous amount to overcome. I mean, just paying the interest on it every year. Most loans are somewhere around 6%. So, it's a real killer for people. And no matter if you are smart and you do go to school and you work hard, when you go out there and you're trying to start your own practice with the obligation of paying back $250,000 at 5 to 7% interest, it's going to be a tough life for you.
Mm-hmm. So is that kind of the obviously there's any reason to put money away for your kids' education is a good one, but obviously you've had, because your children are fairly young, so to be able to be this active and engaged with creating those savings for their education? What was, where did that motivation come from to start that as early as you have?
Well, I plan on sending my kids to private school through K through 12, and the CESA account is special in that it allows you to spend the money on K through 12 education. I think most other college savings plans I've looked at only let you do college,
Mm-hmm.
and so that's why I chose the CESA. And honestly, I'm pretty active with it because I would like to shift that that K through 12 education burden from me to that account. If I can build it up high enough, then I'm not having to pay the taxes on the money when I'm making it because I was just going to pay tuition with it anyway. So now, but I've got to get those accounts up big enough so that they can actually pay that cost for them. My ultimate plan is to try to get it up there around $250,000 a piece, and then buy a few assets that just produce rent. And then once they have those, then the rent will just pay the tuition every month, and that'll be a burden that I don't have. And then it can actually follow them through life, all the way until through college even.
Mm-hmm. Yeah, no, that's exactly what, and we had talked about previously, and it brings us to the next investment, because the first investment that kind of kickstarted the kids' CESAs with at the vacant lot, you then moved on to another investment of 2 adjacent lots in Nashville. Can you tell us a little bit about that next one?
Yeah, actually, I found that on Craigslist of all places. A guy had it on there. It was, this house and then the lot next door, and he wanted to sell it for 120. I think he wanted 120,000, and I've learned through my experience, even though if you feel like it's worth it, you must always negotiate. So I offered him some lower amount, and he refused, and we came to that agreement of what he wanted exactly, the 120,000. With that property, it wound up being it was 2 adjacent lots, but at some point in history, it was actually three lots already. So but someone had just cut it in half by deed and not actually replatted the lots. So turning it back into 3 lots was a lot less trouble than it would have been otherwise. So we merely just did it by deed. We put that back to the original 3 lots that it was, and then once all of that made it through the codes department so that they actually agreed with us, then we were able to sell it, and they were able to build 3 houses on them. And we didn't have to tear down the house or anything that's on there.
Great. So then in this one, for this investment, you had included, in addition to the 3 CESAs for 3 of your children, then your Roth IRA and your wife's Roth IRA also joined in on this investment, correct?
That's right, yeah.
Okay, so the 5 different accounts, similar to the previous one were the 3 CESAs. This time, because the purchase price, we're getting up there a little bit and into a little higher purchase price, you brought in your Roth IRA, and then your wife decided to direct her Roth IRA into this as well. So the 3 or the 5 of you purchased the 2 lots, and that's when you mentioned that you didn't actually do anything with the house or anything but divide the lots and then kind of market the property differently. Was that kind of your approach with this one?
That's right. The guy that was selling it before was selling it as a house to renovate and, possibly a buildable lot next door. He wasn't really guaranteeing it because of what I'd mentioned before. Someone had subdivided it by deed, and they never actually did it legally, which turned out to be better because then instead of having 2 building lots, we had 3. But, yeah, he was trying to sell the house, and clearly the house is just a demo project. It's not something that anybody would really want to renovate.
Mm-hmm. So you saw, and once you kind of the 5 accounts took title to the property and everything, then you started talking about it as basically just lots with something the house will have to be removed. But then you eventually, who did you eventually end up purchasing this from the 5 accounts? You sold it to another developer in the area?
That's exactly right. I sold it to a man that builds houses, just a developer around in that area of Nashville. And I see you have the slide up now of where, he built these 3 really nice houses on them, and I think he was selling those around $350 a piece. Mm-hmm. And actually, I looked at it maybe a month ago, and he already had a contract on one of them.
Wow. So it seems like just for our listeners today, this was the before, when Brian's Roth IRA, his wife's Roth IRA, and his 3 kids' CESAs purchased these 2 lots with there's the house that needed demoed. And then not too long after, you said maybe like a year of development, or give or take, then this is what the developer who purchased the lots has done once they were divided into 3, which obviously, from just even the community in the area, I'm sure they were pretty pleased with the development of that area from that before picture to where it's going to be in just once these houses finish up. That's a pretty significant transformation in that neighborhood.
Yeah, one thing I didn't realize that these 2 had in common until just right now is they were both on dead-end streets, and, the area looked pretty funky, honestly. Just not a dead-end street that you really want to be driving down, but now both of them look great.
It's interesting how the similarity between the 2, and it's not like you were going out searching after the first one. All right, now I need to find another dead-end street property. It just happened. It was just a coincidence that you just kind of are putting together, staring at the thinking through right now.
Yeah, and off subject slightly, but even the house, I bought a new house within the last year or so, and I would drive the neighborhood that I was looking, and I would never go down this one particular street because it was kind of narrow and it was a dead end. And I was thinking, man, I don't want to go in there. There's all these construction vehicles. I don't want to, they're not going to find anything down there. And lo and behold, I wound up buying my personal residence on that dead-end street that I thought was kind of narrow. And because I didn't drive down it and I didn't contact the builder, I wound up buying it through his real estate agent and had to pay a 3% commission. So I missed the opportunity on that one.
Yeah, I guess the lesson here was to go investigate some of the dead-end streets. You never know. There's some of the diamonds in the rough over there, huh?
Yeah, that's awesome. Anyway, yeah.
Yeah, that's great. So these, because of, and similar to the previous one, that investment was split between the 5 different accounts, your Roth IRA, your wife's Roth IRA, and then the 3 CESAs based on the percent ownership that it was purchased at. But just these 2 real estate investments in the last, 1.5 years or so with your family accounts, that both of them ended up being about $130,000 in profit. And because you use your Roth and your wife used her Roth, that those returns are able to be tax-free, assuming that they remain in the account till after age 59 and a half, and all the IRS rules are followed and all of that. And then for the kid CESAs, assuming that their share of that profit returns and is used for qualified education expenses, that's also tax-free for their education expenses, whether private school or on down the line. So really, Brian, it's an incredible story all around. And I'm hoping that all of our listeners can see why Brian was selected our Investor of the Year, just because of the ability to partner the accounts, the ability to bring his kids' education savings along for the ride, and then both of those investments have obviously done significantly well from an ROI perspective. So Brian, that's just congratulations to you again for the award, but also for what we were able to put together and come up with. So is there anything, when you look back now at some of those 2 investments or any of your other investing, that you kind of that hits you or you take away of that you might want to share, if there's any thoughts about those 2 investments particularly?
No, I mean, like I mentioned, the person I sold the first one to, they wound up rezoning it. And, that's something that I've taken into consideration, and I look at with each property now is there a way to rezone this to get, to make it more valuable? And I've not been able to do that yet, but that's something I'm looking into moving forward.
Great. So in addition to the returns, you also are learning as you keep going and working on these different things, you're picking up new stuff along the way.
Oh yeah, definitely.
Awesome. I mean, it really just a tremendous job there. So at this point, I want to emphasize the power of tax advantage compound interest for our listeners, because when we're going to it's going to be a hypothetical example, but on that one investment, I think, they came back right around $53,000 or something to the Roth IRA. And so let's just assume, taking $53,000, and for the next 23 years, that just the annual rate of return is 8%. And this is just an example to kind of demonstrate what taxes or not paying taxes in the Roth can do over the long period of time. So assuming that there's a 25% marginal tax rate, that even without putting another dime out of your pocket into a Roth IRA, so $0 into contributions, that Roth IRA could potentially grow up to over $311,000. And if you compare it to doing those same investment, the $53,000 principal, 23 years, 8% with a tax rate of 25%, that same thing would only be a little over $202,000. So there's actually the use of a Roth IRA, and this is just to kind of demonstrate the tax advantages when they compound, like you mentioned earlier about the CESA, or not having to pay that short-term capital gains in the process. When those funds then remain in the account and are able to be reinvested, they compound in that tax advantage environment. And in this example that we're just using kind of to paint the picture, it ended up being $108,000 plus in using a Roth, and as opposed to outside of the Roth. And I'm sure some of you have heard the phrase, it's not how much you make, but it's how much you keep. And that's really kind of what the power of the self-directed IRA and the Roth IRA and the Coverdell Education Savings Account and the different plans that we offer at Equity Trust. It's that they are vehicles that have those tax advantages, so that those investment returns stay in the account, can be reinvested, and can compound over the long term. So I just wanted to kind of jump in and share that to kind of put some of the things that Brian's doing in perspective, because I think, Brian, you mentioned your children have been, they're not in school yet, so you still have a little bit of time to get these accounts to continue working for you. And then even for your wife and your retirement accounts, you've got some time as well. So is that kind of the goal, is then to continue, the using that time to keep at it and what you've been working at?
Oh yeah, and my oldest is in he's going into second grade, so I do have one in school and got one starting school, kindergarten. But yeah, that's exactly it. My ultimate goal is to make the maximum contributions every year, and then eventually have enough capital in these accounts so that I can do any kind of short-term stuff with my IRAs, and not have push all that out to the future, and keep the rentals that I have and the long-term buy and sell deals, and pay long-term capital gains on it. So even looking at your projections there, I mean, I thought that short-term gains rate was closer to 30%. I didn't know it was. I thought it was 30 or 33.
And that's really, since that was just a hypothetical scenario, we just pick a tax rate just for the purpose of demonstrating. But obviously, for anyone listening, everyone has their own kind of tax brackets, and all the investments are different. So that was mainly, it could be higher. The tax savings could be even more profound depending on what tax bracket. They could be less. But that was really just the example that we came up with, just to kind of paint the picture of what taxes do when they're eating away at the returns compounded over 20, 30, 40 years.
Oh yeah, well, if anything, it's that or even better to have an IRA. I guess is my point.
Yeah.
So yeah, that's what I'm hoping to do, though, is in the next 5 years, try to grow these things as much as possible. And I actually just sold another, where you guys have that one that we sold, the two that we did, and then we bought another house and just sold it, and I wrote a contract on another. So I'm just trying to keep things moving with it and make as much as I can there. With me, in the past, I used to do things as short-term capital gains, and we actually changed the way that I file my taxes now and made it more of actual income. I forget how they reclassified, but it's they reclassified it as a business because I'm not practicing optometry anymore. It used to be just a side thing, and now it's my primary way of doing business, making money, as real estate. So we reclassified that as income, and then I'm able to contribute a lot more money into the SEP accounts and not just the IRAs. So
okay, that's actually fascinating. That's a fascinating point because so you were basically took from your real estate investing, which you had initially done on the side, and said, all right, I'm doing enough here. I've got, this is working for me. You decided that that was going to become the business, which then allowed you once you established the business, you were then able to open the SEP IRA, the SEP IRA, which has the higher contribution limits, but then, okay, so that's actually really interesting, Brian. So have you been with some of the more recent investments that you've been doing? Is it kind of a mix, or are you partnering all the accounts on each one of these, or is it kind of, it depends on the investment and how that works?
Yeah, if it was something that, I thought this is a home run, we're going to score really big, I would put my kids' accounts on it because they're so much harder to get the amounts, get the volume up. But in general, I'm just trying to do it where it's simplest. Like since my wife and I can have the SEP accounts, then, if I'm able to put enough into those to buy the whole investment, that's what I'll do. Just whatever requires the least paperwork, honestly, or in those special cases where I'm trying to push my kids' stuff up.
Brian, thank you so much.
All right. You have a good one.
And one of the ways that is possible to educate yourself more about self-directed IRA investing is the national conference that we'll be hosting across the street from our corporate headquarters in Cleveland, Ohio. The Equity Trust Company Wealth Building Summit will be Saturday, August 18th through Sunday, August 19th, with a bonus day on Friday, that 17th. Hundreds of other investors will be there for a weekend of education and networking, and we're holding out hope that Brian's going to be able to make it in and to join us as well. But we'll have panels of Equity Trust clients sharing their experiences, sessions for both novice and experienced investors, and just a whole lot of education and networking opportunities where we're bringing in, it'll be one of the largest, collections of self-directed investors and people in that space with an interest in that. So if you ever wanted to learn about self-directed IRA investing, or you're looking for new ideas, I'd encourage you to join us for this weekend. You can see the website on the screen. If you go to www.iraevents.com, you'll also find the link for the Wealth Building Summit in the menu, or you can go directly to the link on the screen. Or you can email us at webinars@trustetc.com. Mention you're looking to learn more about the summit, and we'll make sure that we can help you out with that. Finally, you can also reach out to us for more education if you're looking to learn more about something. We have a whole team of senior account executives available to help you with questions about our accounts, kind of walk through why Equity Trust and some of the things that we do, and why this might be a good place for you to decide opening in a self-directed IRA if it's right for you. You can give us a call directly, 855-673-4721, or visit the link that you can see on your screen where you can send in questions that you might have and schedule a consultation where then we'll follow up at a time that works for you. You can also chat with us by going to our website, www.trustetc.com, or you can email us directly at webinars@trustetc.com as well. So I promised at the beginning that if you send us an email, that we'll send you a free digital copy of our book. So here's the details for that. Like I mentioned, just email webinars@trustetc.com, put book in the subject line, or put event in the subject line, or whatever it is in those emails to let us know what you're looking to learn, how we can help you, and we'll be sure to get back to you as soon as possible. And I want to thank all of you for joining us today, and I want to give a special thanks to Brian for taking the time to share his story with us as well. I certainly enjoyed our discussion, and I hope all of you did too. So until next time, everyone, thanks again for joining us.